Hello, and welcome back to our Financial Statement Analysis Reading Between the Lines video lecture. We're going to explain the purpose and process of various methods of financial statement analysis. Some of the methods that we're going to discuss are horizontal or trend analysis, vertical, common size analysis, ratio, cash flow, and journal entry testing are just a few of them. Financial statement analysis is the examination of financial statements for the purpose of acquiring additional information, such as questions or concerns about the activities of a business. So the analysis is not conducted in a vacuum. The financial data must be viewed in context, such as market information, industry information, accounting principles, key employees, and historical trends. There are various methods of analytical reviews that we can use, and some of the most commonly used by forensic accountants are trend or horizontal analysis, common size analysis, which is vertical analysis or component percentages, ratio analysis, budgetary comparisons, industry benchmark comparisons, examination of footnotes, and then we can also review the general ledger and adjusting entries. So financial statement analysis requires both internal and external comparisons, which can reveal unexpected relationships or the absence of some expected relationships. So an internal comparison involves comparing the subject company's current performance and financial condition with its past experiences. These comparisons allow us to examine changes within a company over time. External comparisons involve comparing this company with similar companies within the industry or as a whole using industry averages. Forensic accountants are usually part of engagements that require the analysis of financial information and financial statements. So examples of these engagements include we could do business valuations, we can do this for divorce or mergers and acquisitions or liquidations or gift and estate tax. We can also look at management assessments. Forensic accountants can be part of contract negotiations such as employee collective bargaining agreements, part of reorganizations, buy-sell agreements, shareholder disputes, damage claims such as property liability or business interruption or punitive damages. We can be part of financing arrangements, bankruptcies, incentives, stock options, government actions, fraud, a whole slew of engagements. So the forensic accountant uses the same tools as a financial analyst, but with a different mindset. So in a forensic accounting engagement, the analysis is conducted with an attitude of professional skepticism, above and beyond that of an auditor. So the purpose is to identify not just the expected results, but also those unexpected results, those inconsistencies that may highlight areas for further investigation. Moreover, the forensic accountant commonly works backwards using incomplete information, whereas an accountant or auditor typically works from the source of an economic event to its representation to the financial records. The accounting cycle starts with a transaction or an event, and that process involves identifying, classifying, quantifying, and recording the transaction. So the process is performed throughout the accounting period as transactions occur. And at the end of the accounting period, we generate a trial balance, debits equal credits, corrections are made such as adjusting entries, and the financial statements are prepared. And financial statements are used to convey a concise picture of the company's operating activity and hopefully related profitability over a period of time and its financial position on a specific date. So the three financial statements are the balance sheet, the income statement, and the statement of cash flow. We know that the balance sheet, the purpose is to show the financial position of an organization on a specific date. The purpose of the income statement is to summarize the performance of the organization over a specific period of time, such as a quarter, a year, or a month. And the statement of cash flows covers the reporting period and serves to reconcile sources and uses of cash, which are classified as operating, investing, and financing activities. The primary methods that financial statement analysis employed by forensic accountants include a horizontal or trend analysis, a vertical or common size analysis, ratio analysis, and the cash flow analysis. Just as each financial statement offers a different perspective of a company's financial activities, so do the various methods for analyzing statements. So due to their complementary nature, these methods are most effectively applied together in a relative process or in a sequential process. The primary methods of financial statement analysis employed by forensic accountants include horizontal or trend analysis, vertical common size analysis, ratio analysis, and cash flow analysis. So horizontal analysis compares key financial statement items over time from one accounting period to the next to identify changes that may warrant further investigation. The analysis is usually performed in two ways. We could do it by absolute dollar amounts or percentages. So with absolute dollar amounts, we're comparing changes in absolute dollars, right? That can assist in identifying the effects of outside influences of a company's, such as if maybe input prices and fixed cost increase. Percentages is tracing percentage changes is useful when you're comparing companies of different size. The most important relevation of horizontal analysis is a significant trend. Trends in direction, speed, or magnitude can be compared within a company over time and with similar companies or with industry averages. So trend analysis commonly includes comparison of growth rates of key accounts. One valuable growth measure is the compound annual growth rate, CAGR, which reflects average annual growth over a period of multiple years. And an advantage of using the compound annual growth rate, or CAGR, is that it smooths the year-to-year volatility of annual growth rates, reducing the noise in the analysis. Another application of trend analysis is the comparison of a company's reported growth to its sustainable growth rate, SGR. The SGR is the maximum growth rate that a company can sustain without obtaining additional financing such as debt or equity. Vertical or common size analysis compares the relative size of key accounts by converting all income statement items to a percentage of revenue and all balance sheet items to a percentage of total asset. The primary advantage of vertical analysis is that it allows the comparison of financial statements regardless of the firm's size. As with horizontal analysis, common size or vertical analysis, we common size the financial statements and then we can compare them over a period of time with similar companies and also with industry averages. Ratio analysis. In a formal setting, such as like a deposition or a trial, the forensic accountant might describe financial ratios as quantitative indicators of a firm's financial strengths and weaknesses. A financial ratio is simply a ratio expressing the relationship between two items reported on the financial statements. Ratios can be expressed as fractions, decimal, percentages, or relationships. Ratio analysis is made possible by the structure of the accounting equation. Assets must equal liability plus owner's equity. In a system with good internal controls, and accounting transactions are recorded in a manner that keeps this equation in balance. And while the equation is simple in terms of the mathematical construction, there is some genius in its simplicity. Maintaining equality in the accounting equation causes the income statement, balance sheet, and statement of cash flows to be interrelated. So it is difficult for a financial statement manipulator to maintain this symmetry, and financial ratios often reveal the dissymmetry caused by false reporting. So financial ratio analysis allows for a large number of items in the financial statements to be reduced to a smaller number of ratios. No single ratio provides enough information to develop a complete understanding of the financial condition or performance of a business, but each ratio can be used to identify specific strengths and weaknesses that contribute to the company's overall financial viability. Two conditions must exist for ratios to be useful in our financial statement analysis. One, the ratio must be meaningful, a significant comparison, and two, there must be a standard of comparison, like is this ratio good or bad? Financial ratios are generally grouped into 5 categories, as you see here. You see here 2 of the categories. The usefulness of this categorization is to describe the information provided by the different ratios. For example, leverage ratios provide the organization's debt position, while liquidity ratios describe the ability to meet short-term obligations. Here you see our profitability ratios, our efficiency and utilization ratios. And then here we see the leverage, liquidity, and equity ratios. Return on equity, ROE, is the most widely recognized profitability ratio. In the DuPont model, which was developed by financial executives at the DuPont organization in 1919, return on equity is broken down into three component ratios: net profit margin, total asset turnover, and the equity multiplier. The DuPont model highlights the fact that two companies in the same ROE may not be of equal quality. For example, a company with poor profitability and efficiency could artificially boost its ROE by taking on excessive debt. The Altman Z-score enhances the usefulness of financial ratio analysis in assessing the performance of a business, specifically its profitability of experiencing financial distress. So when applying financial ratios, the inputs of these ratios must be examined for validity. After all, the results of the financial statements analysis are only as reliable as the source data, garbage in, garbage out. So by identifying the reasons behind financial ratios, whether they're strong or they're weak, the forensic accountant can obtain a bigger, better picture of the company's financial conditions. Although financial ratios provide useful information, some caution should be exercised when you're doing their interpretation. You should avoid using simple rules of thumb because valid judgments can only be made in comparison to relevant benchmarks, such as similar firms or industry averages. Another important consideration is the standardization of the accounting data used for the comparisons to ensure that you are comparing apples to apples and not apples to oranges. Footnotes provide details about long-term debt, such as maturity rates and interest rates, and that can give a better picture of the company's liquidity and future cash flow challenges, if any. And footnotes may also describe errors in previous accounting statements or pending legal actions. So in reviewing the footnotes, the forensic accountant can seek to identify what might have been omitted from the financial statements in the first place. Financial statement analysis has traditionally focused on the data in the income statement and the balance sheet. Although the income statement discloses the results of the company's operations for a specific period of time, it does not report the results of other activities, such as financing and investing activities. So similarly, although comparative balance sheets illustrate changes in assets, liabilities, and equities, they don't explain the causes of these changes. The only financial statement that provides this information about the company's operating, investing, and financing activities is the statement of cash flow. The purpose of the statement of cash flow is to provide information about a company's sources of cash inflows and outflows during the reporting period, which may be attributable to operating, investing, or financing activities. The net cash flow from these activities should equal the overall change in the reported cash balance during the period. The statement of cash flows is a powerful yet underutilized data source for the forensic accountant. Its value is attributable to the fact that it is the most difficult financial statement to manipulate. Despite the value, the forensic application of cash flow analysis is not always recognized. So a common method for preparing the cash flow statement is the indirect method, which requires reconciliation between the accrual and the cash basis of accounting. So to reconcile net income to net cash flow, you have to remove the effects of accrual basis transactions that have no cash effect. And you have to include the effects of the cash basis transactions that have no effect on net income. So 3 cash flow analysis techniques are reconciling cash, cash flow comparisons, and trend analysis. To reconcile cash, that's done to ensure that the net cash flows for a given year matches the changes in the reported cash balance from the beginning of the year to the end of the year. A discrepancy in this regard indicates that either the cash flow statement has not yet been prepared correctly or that all cash transactions are not accurately reflected in the income statement and the balance sheet. Then the cash flow comparisons. Another useful tool is to compare various measures of cash flow, such as operating cash flow and free cash flow, to each other and to net income. Manipulated financial statements often exhibit unexpected relationships and trends. Trend analysis. As with the income statement and the balance sheet, horizontal trend analysis can be applied to the cash flow statement, and cash flow trends can provide an indication of the company's future direction. So for example, are we doing investments in fixed asset that may signal plans for future expansion? Following the numerous accounting scandals over the years, financial statement users have become more skeptical of earnings-based metrics of financial performance. This has resulted in an increased focus on cash flow statement, which is more difficult to manipulate than the income statement or balance sheet. However, manipulations that serve to artificially boost reported cash flows are still possible. These techniques, which may not constitute GAAP violations, include stretching out payables, financing payables, and the securitization of receivables. So stretching out payable is probably the simplest means of a company to improve the operating cash flow. It's just to slow down the payments to vendors and suppliers. Now, a little bit more complex variation of stretching out payables is the financing of payables. Now, this involves a company borrowing from a third-party financial institution to pay its vendors in the current period with the intent of paying off the loan in a subsequent period. And then securitization of receivables is to accelerate cash flows. A company can package its accounts receivable and transfer them to a financial institution. Under certain circumstances, GAAP allows the company to report the sales proceeds as an operating cash inflow. Journal entry testing identifies several common characteristics of fraud entries. Some of these characteristics include, like if you've made entries to unrelated or unusual or seldomly used accounts, you could have entries made by individuals who do not normally make journal entries. You could have entries recorded at the end of the period as a post-closing entry with no explanation, journal entries having no account number, or any journal entries that contain round numbers or consistent ending numbers. You can also have some journal entries applied to accounts that contain certain complex transactions or contain significant estimates or end-of-period adjustments that have been prone to errors in the past, or they could have not been timely reconciled, or they can contain intercompany transactions, or may be associated with an identified fraud risk. And this concludes our lecture. Thanks for watching.